Welcome to Cooking the Books. I'm Frances Cook. KiwiSaver is really important, not only for our long-term futures in retirement, but also our short-term futures of buying first homes. Figures from the IRD show this year, in July alone, $125 million was pulled out of KiwiSavers for first homes. In fact, research from CanStar shows about half of 18 to 29-year-olds are putting money into KiwiSaver purely to get that first home. So that's a pretty major contribution. However, that same research also showed something a little worrying. Those same 18 to 29-year-olds are quite confused by the different fund types and how to use them. That's crucial because the fund you use could mean you put in the exact same money but get something totally different at the end. So, let's demystify it.
News Talk ZB presents Cooking the Books with Frances Cook.
I'm joined now by Jose George from CanStar. Now, you've put some research out that shows young people are really relying on KiwiSaver strongly, which, first of all, I see why. It's a great scheme, but there's some confusion about the right things to do with it. And some of these settings can be really important. So what are the main areas of confusion that you've found?
Francis, absolutely right. I think young people clearly see their KiwiSaver deposit as a stepping stone to a first home. So that we know from our research. But what we also have found out, interestingly, is there are a couple of things that are holding them back from leveraging it the way they should. I think primarily, if I pinned it down to probably two or three things, the first one is there's a lot of confusion around what is a passive fund as opposed to what's active. The other thing really is there are so many funds available. Which one's the right one for me in terms of building a deposit to my first home? And probably the last thing is confusion around small print, the fine print. Those are three things that really hold people back. And whether we picked it up in our research or anecdotally, that seems to be the biggest area of both confusion and therefore a bit of concern from young people.
Okay, let's start with the first one then, passive versus active. Really important. In a nutshell, what's the difference?
Great question. So really what fund managers do when they sort of collect or take care of your money, your KiwiSaver savings, is really figure out how do they want to make that money grow for you. So an active manager really looks at it and says, I'm going to track this investment and make sure that it's put in the right kind of places to ensure that it's growing at the rate that we want to return for you. Now, that's one way of looking at it. Whereas on the other side, you've got a passive manager who indexes it against a stock market, for example, or puts it up against an index. So what it really does is it mirrors how the market's moving according to that index. So that's another way of looking at it. Now, the difference being, of course, a passive manager would therefore ensure that your money always grows as per the market movement. Whereas an active manager would want to believe that they're making sure that their money is actually growing better, if not worse, if not at least as what the market's growing at.
Yeah, it's interesting, isn't it? Because there's so many promises made with the active management, and you just keep seeing all of these studies coming out. They are meant to outperform the market, and they cost more usually because you're getting that personal touch. And yet often they do worse than the general market or the passive investors. What's your point of view on that?
Good question, Francis. Now, the point with all of this is I believe from a KiwiSaver member's point of view, you're absolutely right. I think the point here is being aware of what I'm being charged for my KiwiSaver and what am I getting in return is always the key driver. The key decision point should be that, rather than am I in an active fund or am I in a passive fund? That's important to know. But at the end of the day, what we've seen from our research is our members keep telling us is we need to see and make sure that we're getting value for money. We want to make sure that we're getting performance returns. And we want to make sure that our KiwiSaver funds are actually talking to us on a regular basis. So yes, that whole active versus passive is very important. But at the end of the day, what really matters is my money working for me?
Mm. Well, on that point, yeah, one of the other things that your research pointed out is that people were confused by the difference between the conservative, balanced, and growth funds, which is, to my mind, one of the biggest, most important settings in your KiwiSaver. Can you run us through why that's important and what is the difference between those?
Absolutely. So, appetite for risk should probably be one of your primary drivers in deciding what fund I choose.
Hmm.
Now, what the KiwiSaver scheme allows is really an ability for a member to set their fund up at the risk appetite or risk profile that best works for them. If I'm someone who's really worried about my money and need to track it every day to make sure it's not losing, or if it's not falling behind, then clearly my level of risk might be far lower than someone who's quite keen or quite able to put that money away and forget about it in a sense and say this is going to roll with the market. There might be ups and there might be downs. So it's really all about risk versus return. Your high risk always tends to hopefully get you better return.
Mm.
So what the KiwiSaver scheme allows is really different settings between, say, for example, a conservative as opposed to a balanced fund, as opposed to a growth fund. It's all about what percentage of that fund is really invested in riskier assets. Say, one extreme, you've got a cash or cash equivalent kind of investments, which is really low risk, and therefore, the higher that setting, the lower the risk. But also that means, therefore, possibly returns are never going to be as attractive as probably at the other end of it, which is all about investments in growth assets, which probably primarily means shares and property, which have always, or traditionally, if you look back at the last 10 years, for example, have grown really significantly. And therefore the returns are high. But what you also therefore see is when there's a bit of a downturn, it also therefore means that your investment is not probably going to return the levels that you got used to in the last 10 years. So it's a bit of risk that you're running with, which you just need to be aware of.
Yes, yeah, exactly. I always like to think of conservative balanced growth as a bit like a sliding scale in terms of the conservative is exactly what you might think. You know, your money is quite safe, but it's also not growing. You've got balanced in the middle, and then you've got growth where your money will hopefully grow. But it does that by taking calculated risks. It's not risks in the normal daily sense, it's risk in the investing sense where it goes up and
Absolutely.
down as it goes up.
Absolutely. Absolutely.
And I think if people can understand that and also understand the factor that time plays in it, right? So you might want to earn more money in your KiwiSaver and be like, yes, that's a great way to boost up my house deposit. But be aware that it will sometimes go up and down and that it needs time to do that. You know, if you're hoping to buy
Right.
a house within the next 6 months, probably not for you,
Probably not a good idea. Exactly.
right? And
Exactly right. So
figuring out how time works, and that's so important, right?
very true. So I think to your point, it's really the first point we talked about was risk versus return, which you brightly pointed out. And the other thing is how long am I in this game for? I mean, am I here? Am I looking to buy my home in the next couple of years, and therefore am I building up a deposit? And so, is this KiwiSaver investment all about making sure I've got that money growing, but growing safely so that I can tap into it in the next coming few years? Or am I in this for a long-term retirement fund? In which case, you've got two very different strategies to play. We talked of the risk appetite, we talked of time frame, we talked of stage of life. Those are really important factors that you want to consider when you put your money into a type of fund. So if you were, for example, looking to save up for a first home deposit, and that's within the next, say, 3 to 5 year time frame, you probably would be better off keeping it in a lower risk and therefore maybe a conservative type of fund, only because it gives you that feeling of safety, or that feeling of being reassured that I can tap into it when I need to, and it's not going to lose much value. Whereas if I'm saving up for another, say, 20 to 25 year time frame, and I know generally looking at the market, it's always grown exponentially, so to speak, both in terms of how the market's grown and also by way of the magic of compounding. It really works for me to keep it in something like a bit more riskier, like maybe a balanced or even a growth, or for those who really into it, an aggressive kind of fund.
Yeah, I'd love to know what you think as well, because there's a bit of an in-between strategy there as well. If we're talking people who are trying to buy their first home, and sometimes, if you are living somewhere expensive like Auckland, or this is just, your job's not paying you enough for you to be able to save as much as you want. If this is going to be a really long-term goal for you to try to get into your first home, but you want it and you're focused on it, but it's maybe 5 years plus. There is the idea of sometimes putting your KiwiSaver into growth when you have 5 years or more as a
Yep.
way of supercharging it. What do you think? What's a good rule of thumb on how much time you'd need before that's a good idea?
Um, there's never there's no absolute exact science to this, but really what we're saying is if you've looked at the way the markets have moved in the last few years, say if you look at the housing market, for example, we've tended to see a bit of a doubling effect every once in 7 to 10 years, for example. So as you'd know, therefore, clearly, if you're investing at the riskier end of the market, as in a growth fund or an aggressive fund, what you can safely assume, or you can't safely assume anything, but what you can sort of safely say is, I can expect my money to sort of grow really well in that kind of time frame. So if I'm looking to buy myself a property in the next, say, 10 years or 15 years, I would suggest that a growth fund is probably the right place to put your initial investment away, keep it growing, add the value of compounding and the way the market's gone, and you'd probably be far better off looking at, or rather being able to afford in some places like, say, an Auckland or a Wellington or a Christchurch, because where you've seen property values, one, high, and two, growing significantly as well.
Yeah, yeah. And like you say, it's so hard talking about this stuff because it is all very much general rules of thumb and everyone's situation is different. But it's some good ways to help people try to navigate this.
That's right.
I would say as well, we saw in March, this is why we're talking about the need for time, right? Because in March, all of a sudden, pretty much overnight, the market crashed. And if you'd been hoping to buy a house about then and you had had your KiwiSaver in growth, that would have been terrible, and you got pretty much no warning about it. The other thing, though, of course, is once the market has crashed, if you are in a long-term strategy, do not
Yep.
panic because you've just turned into a long-term strategy into a short-term
And
strategy.
the short strategy, exactly right. So that the worry of crystallizing your losses every time you sort of want to act when you see the market turn downwards is a big risk you run. And so that's something which is really important for people to be aware of. KiwiSaver, yes, it's a great way to get onto the housing ladder, but it was always meant to be a long-term investment. And with any long-term investment, you get the ups and the downs. But the important thing to bear in mind is on the downside, on the downslide, you're not crystallizing, or rather, you're not running the risk. You run the risk of crystallizing your loss if you decide to jump out. So
Mm.
what we've always seen, yes, markets do turn down, but they always tend to turn back up again. So it's important to be able to ride those waves and make sure you're in it for the long term. And yes, if you need to exit the market, you need to exit the market as best as you can, but don't crystallize your loss every time the market turns down.
Yes, yes. Which of course just means don't sell out and then lock in those losses,
That's
is
right.
what we mean when we talk about crystallizing there. Now, you've mentioned when what you get for what you're paying, and
Yeah,
that's a really important issue in terms of the fees.
yeah.
So KiwiSaver actually is somewhat notorious at this point for having fees associated with it that are far higher than equivalent retirement schemes around the world. I do hope that some action gets taken on that soon because it looks like the providers aren't going to do it. But until then, it's really important to know that you've got to look at your fees yourself and you've got to
Yeah.
make educated choices on that. Is there a rule of thumb in terms of what sort of fee level is acceptable or worthwhile?
I think, Francis, is a really good question, but also a very difficult one to respond to in terms of giving you an absolute number. I mean, if you sort of jumped on to any website like the CanStar website, for example, you can get a good sense of what an average fee is for a conservative fund as opposed to a balanced fund. Understandably, for a balanced fund, given the risk involved with it, you might expect to see a slightly higher fee than the conservative. And as you go up that scale of risk, you probably tend to see higher fees. But to your point, I think it's absolutely clear fees are much higher in New Zealand compared to some of the other markets where you've got equivalent schemes running. And we're seeing a lot of work that the FMA has put in terms of trying to drive that message across, getting providers to be more conscious. But I think at the end of the day, it really falls back on the individual member to be able to say, is that fee the right level of fee, or am I feeling that it gives me value for money? So yes, exactly to your point, providers have really been moving along, but not at the pace at which you'd like them to move. But what that therefore also does is, it then falls on to the individual members to say, am I paying the right fee for this? Simple way of comparison, if you jumped on to the CanStar site or any other site that you might be able to compare funds, you'll get a good feel for the kind of fund I'm in. Say, for example, I'm in a conservative fund. You might actually see the fees range from anything from close to 40 basis points, as in 0.40%, all the way up to 1.5%. Now, really, then the question is, if I'm paying a 1.5% member fee on my KiwiSaver, is that justified? Am I getting the returns that justify my paying that kind of fees? That's probably more important. So while I'm not trying to play down fees and the importance it plays in terms of your end value, what I'm keen to suggest is look at returns and look at the performance of your provider to make sure that you're actually getting value for what you're paying. And that's more important, because in the long term, all the measurements that we do around performance, again, performance can never be, you can never assure performance, but if performance is net of fees, is actually working for you, then clearly your provider is working in your favor.
Yeah, and I'd love to talk about, you say there that you've got information on your site. You often research and grade KiwiSaver providers, and I've actually had quite a few listeners get in touch with me recently from all different stages of life. I've had some first home buyers get in touch, and I've also had someone recently who was saying that they're, in their 50s now and wanting to make the best of their KiwiSaver before they do retire, which is great that so many people, different life stages, are thinking about this. In terms of the different KiwiSaver providers, there's so many now. Which ones have been coming out on top in your research, and what are they doing that's so good?
Sure. If I take one step back, in terms of what drives satisfaction for members, around KiwiSaver members, really three things stand out: performance, a sense of value for money, and communication. Now, fees are important, but the biggest drivers clearly seem to be performance, value for money feeling, and a sense of I'm being communicated to, and I'm therefore being engaged. Now, what I'm seeing is yes, on our comparison sites, you can pick up all the information around who's actually returning you the best performance returns for the fees that they're charging you. And we've seen a couple of providers that really stand out. But what we've also seen on the other side is does that mirror in terms of satisfaction? Are their members equally satisfied with them? We've got a couple of providers that have really stood out. We've recently completed our customer satisfaction survey on KiwiSavers, and simplicity has really stood out by way of its members saying, hey, I'm very satisfied with the returns I'm getting with them. I'm very satisfied with the way they're communicating with me. I'm very satisfied with a sense of value for money. So simplicity, for example, stood out really well in our research. On the other side, we've also just completed our research around looking at the quantitatives, as in looking at performance data, fees data, and features of different funds. And we've got a couple of other really strong providers that have come through. I'd like to make mention of Milford Funds. Milford Funds have consistently performed over the last few years, and in terms of satisfaction levels, really rating very high. So those two, for example, very different strategies. One is an active manager, one's a very passive manager. So really, as I said, the important thing from our perspective is not, are you actively managed or are you passively managed? It's more, am I as a member feeling happy with the value I'm getting out of my fund?
It's so interesting that simplicity has come out so strongly in terms of the communication, because of course, like you say, Simplicity and Milford, very different in terms of their strategies. And Simplicity is one of their big selling points is that their fees are really low. So you're getting a lot for very little there, which is
Yep.
interesting that they then have such satisfied customers when they're getting quite a bargain, frankly.
True that, and I think their biggest selling point to your point has been about their fees. Their fees are very clear. Their fees are low. They've kept them really well controlled, but also they've performed really well in terms of the market because they're indexed. They've indexed against market indexes, and therefore, as you've seen over the last few years, we've had a really good strong run, and they've therefore performed really well as well on that side. So, what again to go back to the point is their members who signed up have got what they've been promised. And so that's really important, which is really, at the end of the day, the biggest driver of saying, am I in the right fund? Is my provider telling me what I want? Is my provider delivering what I was promised? And they seem to have got that clearly. So that's how Simplicity's really stood out. And equally, if I look at Milford, uh, again, more expensive because they're actively managed, but it appears that their members are equally satisfied, or rather really satisfied, with the value that they're getting out of their fund.
That's really interesting. And especially when you mention about the points on communication. And
Yep.
I think, particularly as we head into uncertain waters, and we were actually just chatting before we flicked this recording on about how we're heading into the first recession in a really long time. And it's uncertain for people because we haven't gone through this in forever. And so you kind of have to remember what it's like to be trying to stay employed and look after your money and all that stuff in an
Absolutely.
uncertain, slightly troubled time. And I think your point about both Simplicity and Milford having good communication and keeping their customers happy that way, I think the other
Yep.
KiwiSaver providers should take note. I think that as things are uncertain, customers will be looking more and more to their KiwiSaver providers to communicate with them through this, to let them know what's going on. And I think
Absolutely.
absolutely they should be, right?
Absolutely. I think KiwiSaver is it is one of those. It's an uncertain investment. It's an investment in your future. It's an area that really confuses people, and so the more you communicate, the more you share, and the more transparent you are with your provider, with your members, the better for you.
Hmm. Okay, so let's do a quick sum up. Let's see how much I can remember. Pop quiz for me. So if you have more time, then you are probably wanting to think about something along the growth end, but also make sure that you have the stomach to stay with that
Same
growth
thing.
end if
Absolutely.
you are going for that. If you have less time, think about something on the conservative or balanced end. You can have a look for those KiwiSaver providers that have been winning awards. Shout out to Simplicity and Milford. And also, you can think about things like fees, but more importantly, make sure that if whatever fee you're paying, that you're getting value for that, and maybe look at what the returns are that provider has got after the fees have come out. And that's what we call return net of fees, returns after the fees have come out. How does it stack up afterwards?
That
How's that?
that is perfect. You're on. I think you've probably summarized this better than I would have been able to. So absolutely well done.
Fabulous. Well, I hope that helps any future
No,
home buyers out there, or even anyone who's hoping to retire soon. This will hopefully has brought some clarity to it. Thank you so much. That's just George
thanks
from
so much, man.
CanStar. Now, if you know someone who is in this category, they are thinking about their KiwiSaver or they're thinking about buying their first home and they're a bit confused. If you found this episode helpful, then please send it on to them. We all need a bit more help getting through these times and figuring it out together. You can also get in touch with me, send me questions for future podcasts. I'm on Facebook, Francis Cook Journalist, Twitter, Francis Cook, Instagram, Francis Cook NZ. You can also subscribe to Cooking the Books and make sure you never miss a future episode. Pretty much everywhere you listen to your podcasts, including iHeartRadio, Apple Podcasts, and Spotify. Until next time, have a great day.